You're listening to Giles McMullen chatting to Bill Rook from Redmayne Bentley. We're going to have a look at some charts today, and we're going to start with the FTSE 100. Bill, what do you make of it?
What I make of it now, it was a buy for those. Some of those charts, when the news comes through that you have possible Israeli problems, you have US cliff problems, you have EU problems, and when these things surface, they take the markets lower. On the 16th of November, the market went through the lower band, the red line on the chart there, just in the corner of the box there. The trick here is to wait for it to turn up through the other band, so wait for it to turn up through it. And when it did turn up, it was a buy, as it was on the early September, and it was on the in June this year. They've got three good ones now. And when it goes through there, you can see the effect. Now, when it travels to the other side of the band, you're looking at a 2-3% movement in the market, which if you translate into turbo territory, looking between 30 and 50% rises in your underlying. Now the risk is that it doesn't go higher, but you've got a high probability that the market is oversold, and it seems to be doing it. The worst case scenario here is if the market keeps plunging down, but if you have that, you don't really buy until it crosses the red line.
Right.
To go to re-enter, if you like. It seems in a high probability trading there. I've added another indicator, the breadth of the 350, and that's on that particular day. It's the daily chart. Touch 55.75%. Basically, what is that the percentage of shares above the 200-day moving average was nearly 50-50. And that takes us to oversold. What I haven't added there is behind or back data. That will come later. But all the other indicators are suggesting oversold. The Williams percentile. So that it was a high probability that it was going to bounce. The trouble is with these situations is they can last longer than you'd like. And that's why it's important for confirmation. The confirmation is crossing through the red line. So that's been a good trade, Giles.
Okay, Bill.
For those who took it, yeah.
Thank you for that. Now, on the we're staying with the FTSE and moving to the best performing stock in the FTSE, which is Arm Holdings.
Yeah, since July. Yeah, it's not bad. This one. If you traded just where the arrows were, or the lines at the bottom of those big spikes, since 2004, the signals started coming through. Your investment will be about 104% up, including costs. Now, what's that against buy hold? In this particular case, buy hold is probably about the same. So you haven't really scored many points by trading. But the most important thing about trading the share is the huge consolidation between the 18th of February and the 19th of October. So it's about a year, almost sideways. And that sort of whooshing sideways, thrashing around. It didn't break new highs until October, when it broke at about £6, and now it's 7.62. Now in July, I mean, if you're looking at July time, you're looking at a share around about £4.87. So that's £3 up on that, nearly £3 up, and that's a huge rise for FTSE stock. So I suppose the moral here is that buying a share oversold and bouncing is the way to make money. But you still can make money when it breaks out, where that red spike is on the right hand side. It's not a bad turn, 15-16% up since October. So it's dangerous, I think, holding the share when it's thrashing around. Very lucky if you buy them near the low points. But a fantastic run from 09 to the top points there, to the red arrow there. So yes, it looks like one that's going to go. It looks like it's defying all gravity. It's sort of making the chips for virtually everything now, Giles. So it's been moved as a possible takeover target as well. So it's challenging Intel.
Yes, I mean its chips are in all the mobile phones, aren't they?
Yeah, that's right. That's right. The problem here, from a chartist perspective, is will it continue that meteoric rise, or would you have to go ferreting for shares near the low points or their current low points in the range in order to get the same percentage gains? I fear that you probably would have to go looking for the low end. Therein lies the danger, because there's no point in July that says this is an outstanding buy, other than this is a lucky dip buy down in July,
Right.
honestly. Unless you know the company very, very well and you believe that this is going to happen. It's taking you onto a different realm, thinking a belief is a different realm to that of, well, I can see it from a chart.
Okay,
I think
Bill.
it's very hard. I think it's very hard to call the low points on charts. I'd say this is the definitive entry point. You can do it with hindsight, of course.
Okay, Bill. How about Carphone Warehouse?
Now this is an interesting one because on a daily chart, it's what they call in a flag position. I don't think it's got on the weekly, but it's come out with some very pleasing results. It may even end up with a European business from Best Buy, which has close links with. So that it might end up with that. Come out with some very pleasing figures. This is a recovery play. This is to turn your eye to the left-hand side of the chart with the little showing that blue line. That's probably an exit point when it gets above that blue line because that's 65% above the 200-day moving average, and it's done that twice back in 09 August, and also in November time. Sorry, December sort of 2010. It's been through that, so it's sort of that was an exit point. So this is an entrance point now for me because it's moved above the 20-week high, the red line, and it's above the green line, the 90-day zero lag moving average, and it's coupled with good figures. So this is sort of a magic combination. The trend is looking quite good. So this is the best I can come with a recovery share, and I would say the target on this, from the chart perspective, is in the region of £2.50. Of course, we have to look at the fundamentals, see what's going on, to see whether that's worthy of that. But above £2.50, it will probably be an exit point. So far, this one had it been traded, Giles, from 2005, you'd be 200% up. Now, against buy holds in that period about 26%. So this epitomises the idea of trading. You just don't know what's going to happen next, perhaps potentially, and you just trade the trends, the strong trends. So this one is on the buy list at the moment.
Okay, Bill. Thank you very much for that. Let's finally move to the S&P 500.
Yeah. Now, what we've had here is a broadening wedge on the downside. Only known until it actually broadens, because at one point it's only since November that we've actually realised it's November now. In fact, it's broadening because we have got all the points in place here. So what does that tell you? Well, that little circle on the right-hand side is my target. Why is that the target? Because that is that November high point. It's about 1434. When we break above that, I think we'll be back into a positive trend territory. So the market is a recovery zone at the moment. Certainly the S&P. One worth watching. This is really important, this line. And if it breaks through that, we're back into bullish phase, in my estimation. So we're looking to then possibly challenge the likes of 1470 and beyond. So if we get above 1434, bets on the downside are off, and I think that would indicate that the US issues have been sorted, and we've got some good positive upside.
Okay, Bill. Thank you very much for that. So that's all the charts for this week. We'll chat again next week.
Look forward to that, Josh. Yeah.